Good afternoon. I hope you can all hear me. If you can hear me, can you please give me a thumbs up or give a yes in the chat?
Good afternoon. We can hear you.
Lovely. Thank you. Sir, Ma, thank you. Thank you. It's good to meet lovely faces. Okay, if you're away to make a cup of tea, it's time to come back. Let's start this session. Class is in session. Okay. Thank you so much for having me tonight. I appreciate that you are able to make time out of your busy schedule to attend this coaching. And my name is Tayo Olatimilehin. I'm also an assistant pastor in RCCG. So you can be sure of what we look at today will be not sugar-coated. will be things that will be a blessing to us. Okay. It's a church meeting, so I will say a word of prayer, if that is okay. Father, we thank you. We thank you for the privilege to be here tonight to look at our finances. We receive today utterance, and we also ask for everyone that will be listening. I receive for every one of us a heart of understanding, and at the end of the day, that we all be blessed. And you help us to be good stewards of the things you blessed us with. Thank you, Lord Jesus. In Jesus' name we pray. Amen. Okay, so if you know anybody who is not yet here, that you know supposed to be here, just ping them. Say, join this call right now and thank me later. Say, join this call right now. This is the link. Join this call right now and then thank me later. Okay. It could be any other person from any of your friends or people, especially people who live within the UK. So we're looking today at winning with money. And thank you, dear brother, Pastor J, for giving us this opportunity and this platform to be able to share this teaching. Much appreciated. Okay, and regards to the pastor for also letting me speak to you wonderful people. Uh, that's also much appreciated. Thank you. We do not take it for granted. Okay, so the first thing I will start with is the disclaimer. And today's presentation is for educational purpose only and should not be construed as investment advice. Investment could go up and down in value. And if you want to make any major financial decision, please consult your financial advisor. Thank you. So let's start out of the way. A little about ourselves. We are KWC Global Institute, meaning Kingdom Wealth Creation Global Institute, and we are dedicated to leadership empowerment to achieve profitability or leap in every area of our life. So I've said my name is Tayo Olatimilehim, and I'm a transformation and change consultant with over 20 years experience both in the UK, central government and private sector. And I hold an MSc in strategy, leadership and change. Okay, and that's just a little about myself. But beyond that, beyond all of that is the fact that I am in the journey of building wealth. And over the years, I've gained some experiences that I want to share with you tonight. And hopefully, I want to believe we'll be able to pick one or two things. Either it's a reminder of things you've heard before, or it's something probably new to you. But feel free, please, to stop me and ask questions at any time. Feel free to put things in the chat or to raise up your hand or mute your mic and ask any question that you want to ask. And I think this session is being recorded. Hello, sir.
On Zoom.
Okay.
Sorry. I was just calling somebody to join, some people to join.
Lovely.
Sorry. Let me mute myself. Sorry.
That's okay. So some of our trainees, building wealth for generation, winning with money, and then we have master class for both of them, for both of the two above. Reposition yourself as a career development trainee. And what is our aim? Our aim is to develop new perspectives, to help us develop new perspective and mindset when it comes to the issue of money. and to help us understand the rules of the game so that we can win. You can't play rugby or cricket or basketball or football without knowing the rule of the game and you think you're going to win. There's a need for us to understand the rules that guide money, especially in the Western world. Another thing that we need to look at is understanding the 3 M's of money. What are the 3 M's of money, and what do you need to know about them? And lastly, our aim is that we're able to build lasting wealth that will span generations. Okay, and so I'm going to read the next thing, which is the introduction to this particular concept, teaching of today. And in this a short reading, you'll be able to pick a few things or relate to a few of the statements I'm going to make there. So it's often believed that living in the Western world automatically makes you a millionaire or a very rich person. Okay, and I said it depends on how you are benchmarking your wealth. Are you converting your money, your pounds, to another currency, for instance, naira, or to some other currency, and then it could look so big. But then you soon realize that the high standard of living in the UK, the good life we enjoy in the UK, okay, is at a cost, either a cost to the government or a cost to us as individuals. And for the government, what does government do? They borrow more and they tax us more to be able to maintain it. And for us, we either work more hours or you depend on credit cards and loan to be able to maintain this high standard of living. And also, the system generally does not care so much about you when it comes to financially. We are just the pawn in the game, or the oil that keeps the wheel of the economy running. Basically, we are on our own, because when it comes to, if you look at the campaign, you're going to tax us more. You will be tax, this one won't tax more, this one will tax. It's all about taxes. It's all about getting more from that paycheck that we said is not enough for us. And to be honest, they want to tax us more and they want us to spend more. If you stop spending, there will be economic recession. So they basically want us to tax us more and they want us to spend more. And so nobody has got our interest at heart. I said it will be now in our own best interest to understand how the economy works, and so that we don't be a victim of that economy. And so we don't live from paycheck to paycheck for the rest of our life, or not having what we can call our own, because everything that we own seems to be on credit, or we are not even able to retire at a very good age, or we are not even able to pursue our God-given vision because we just have to get by. You see? And then so we have to be intentional, and that's what I'll be looking at today, for us to be intentional in the way we handle our finances and investments, so that we'll be able to not live from paycheck to paycheck, so that we'll be able to have things that we call our own, so that we'll be able to get off the treadmill of 9 to 5, going to 1 9 to 5 every day early enough, and also be able to pursue our God-given vision. I think this is a worthwhile aim or outcome that I want us to have from this particular training. I'll just try and be mindful of time so that I can give us time to interact more at the end of this particular class. Okay, so the first thing I will look at 2 things very quickly. Look at the principle of the seed and the 3 M's of money. The principle of the seed and the 3 M's of money. If you have pen, you can write. This recording also can be made available at the end of the class, but I want us to focus as much as possible. And the reason why I talk first about the principle of the seed is that when you understand the principle of the seed from biblical perspective, you do not need anyone at all to tell you to do the other things I'm going to teach. You will know that it is the will of God to do, and then we go ahead and do it. So no matter how tough the situation is, never eat your seed. You can write that down anywhere. You can paste it in every wall in your house, that no matter how tough the situation is, never eat your seed. It is your cure for the scourge of famine. Your seed is the antidote for famine. The seed in your hand, which I will explain to us, is that cure for the scourge of famine. Genesis 1:11 to 12 is where God established the principle of the seed. So for everything that God has created, God has put in them the ability for them to reproduce after their kind. There's nothing God created which is living that can't reproduce after its kind. Plants, animal, name it. human being, God has put in us the ability for us to reproduce and multiply after our own kind. That same principle applies to our finances. God has put in your finances, in my finances, the mechanism for it to reproduce after its kind. And that is the law of seed time and harvest. And that is where Bible established, it was established in the Bible. And this world, this universe is sustained, is still existing after thousands and thousands of years. It's still existing because the law, God has set in motion the law of seed. As we know that God will not create another human being and throw that human being on the face of the earth again, because he has put in our loins the seed for us to reproduce. God will not throw another seed of mango, of apple, or cherry, or whatever fruit we like into this planet again. God has put in them a seed that will allow them to keep reproducing after their kind. And if you look at Genesis 41, was the story of Joseph, where God gave Joseph a principle. If you look at every story in the Bible, it's a principle that God expects us to live by. He said they were written for our instruction and for our admonition, unto whom the end of the world will come. Everything you have in the Bible is written, and they are all principle for us to follow. God gave unto Joseph a principle there. He said, he should tell Pharaoh that, Pharaoh, this is what your dream means, but the solution to it is that look for a wise man, a very diligent man who can put aside 20% of the produce of Egypt in the years of plenty, so that they can be made available to the whole nation when the time of famine comes. And that is God trying to establish a principle for us that in our years of plenty, and I regard that years of plenty from age 16, when you start probably get your NI, when you can start making money, to like the age of 55, age of 60 is our year of plenty. And it's our year where you are active. You can do this, you can do that, you can run around, you can pick up so many shifts. A time will come when we'll start slowing down. You can't do so much as you can do again. You just want your peace of mind. At that point is when the seed that we've been keeping aside, and that is when we are supposed to now start enjoying that seed. So this is a principle. If you look at Genesis 26 and verse 12, it's talking about Isaac. He said Isaac sowed in the land and reaped the same year 100-fold. And this was a period of famine. There had been a severe famine in the land. But guess what? Isaac did not eat the seed that he kept in his barn. If they've eaten all the food, but Isaac kept aside the choices of his crop as seed. And he got a time when God gave him instructions, said, don't go down to Egypt, stay here. He stayed, he planted, and he reaped. So you can see that even for, so if maybe you are familiar with farming, you're familiar with going to the farm, you will notice that at the end of harvest, be it yam, be it corn, our fathers, our mothers, they will take the best of the crop and keep it for planting against next year. They don't go to farm, they don't go to the market and go and buy seed, because they don't know how good those seeds are. They will keep part of the current harvest of this year. Some of them will be stored in the roof for a very long time, because they've been preserved to be planted when seeds are needed. And so also us. John 12:24 is talking, it said, except it said a seed, a grain of which we abide all by itself, unless it falls to the ground first, it dies, and then it will bring forth fruit. And that was what God did with Jesus. God sowed Jesus to reap the whole world, to reap yourself and myself as sons and daughters. And today he has billions of sons and daughters because he sowed one son. So that is the principle of the seed. And so in your finances, in my finances, God has put the principle in our finances that when you have £100 in your hand, there is a seed part of it. I know for so long we believe that that seed is our offering. Yes, there's a seed which is your offering. There's a seed which is your tithe. There's also a seed which you are meant to plant, which is the physical seed. We are the spiritual seed and the physical seed. So when no matter whatever comes to your hand, you should not eat 100% of it. You should give to God what belongs to God, and then you should give to your future what belongs to your future. Someone said that every morning your hand has three parts. He said there is a past, there is a present, as a future. He said the past is for you to fulfill all the expenses that you owe. Maybe you've already, maybe your internet, for instance, is postpaid. then you settle that obligation. Then your current expenses, again, you settle the obligation, but there's a part of which is for your future expenses, which is the seed that you need to put in the ground. So I've really emphasized on that. So I'm going to move on to this and show you in practical terms what this could look like. Look at a pepper. All of us, maybe you've seen this pod of pepper or fruit of pepper before. Inside it are seeds. I'm going to play this video, just a very short video, and then you will see what will happen to this, just to drive in and paint a picture of what this is all about. Just a single seed out of it. Okay, I'll pause it there. So you can see that seed, okay, became a single seed was taken out of that pepper. That seed was planted. You can see what that seed became. A single seed gave birth, was able to reproduce after its kind, and we now have a lot of pepper fruit or pods on that particular plant. So I now say, imagine this pepper as your salary. Imagine that pepper as what you got on a weekly or on a monthly basis from your 9 to 5. Now, all you need to do is to pick out that which is the seed part of it. And if you take the whole of the pepper at the end of the month, you boil everything and you eat it, it means you've eaten both the seed and the food. Remember, it gives bread to the eater, seed to the sower. He said your wage is your greatest wealth building tool. Our income is our greatest wealth building tool. Not every one of us will become an entrepreneur. Not every one of us will own a Facebook, a Google, or a Microsoft. Not every one of us. Some of us will work 9 to 5, but you can build wealth while working 9 to 5, and that is the essence of this training. I'm not saying quit your job tomorrow. I'm saying there's a way, and I'll be showing us that way. So every pound you earn is meant to be perpetuated in your hand forever. And I tell people that if you give me £100 or £50 today, okay, my children, grandchildren will eat out of it. Why? Because a portion of it will go into an investment, which will be transferred, which I will eat off, which will be transferred to generations to come after me by the grace of God. And so that is the principle of the seed. And I want every one of us to know that that is God's expectation for your finances and for my finances. We can say it's not enough. As it's coming, the thing is going. And if I have to borrow to augment more. But like I said, Isaac, regardless, there was famine in the land, severe famine, he kept aside the seed. And when God gave him instruction, he planted the seed and he reaped 100-fold in the midst of famine. So no matter what it is, do not eat your seed. We'll get to what you need to do to be able to make sure you do not eat your seed at the end or as we go on in this particular training. Okay, and these are some headlines that I picked online of people in their 60s, in their 50s, in their 70s who are not able to retire. Not because they don't want to retire, but if you don't understand, remember my introduction, if you don't understand the way the economy works, government wants us to work longer. That's the way they can sustain the pension system. Government wants us to work longer. It's likely that the pensionable age is going to go from 60 to 69, 68 to 69 or to 70. They want us to work longer so we could be productive for the economy, and then they have more time to make sure that they are building that the pension can pay us that little amount they want to pay us, which is I think about 12 or maybe 12,000, whatever thousand it is right now. So they want people to work longer. So there's a need for you to understand that if you think you can retire at 50, 55, 60, you have to take extra effort to be able to do something yourself. So and if you look at how much you need to have a comfortable retirement, you see some of the figures here. For a single person, you're looking at almost 500,000 in your retirement pot for you to be able to have a comfortable retirement. For couple, 500 each. And that's for comfortable 500,000 each, maybe 900 for people who are couple, to be able to really sustain our current standard of living or even have a better one. So there's a need, and whatever we are contributing in our workplace pension is not enough to get us here. It's not that 5% they are removing is not enough to get us to this amount. And that is why it seems as if a lot of people can't retire, because by the time they look at maybe the annuity that their money can buy, it can't last them for, it's so small that they know that they can't really enjoy themselves so much. So there's a need for us to learn the following in order to be able to overcome those issues I've highlighted in that slide. You need to understand how to make money, how to manage money, and how to multiply money. You say, yes, I'm already making money. And that's very, very good. But we look at what again you need to do to be able to make more money. Okay, so to do this, which is number two things I say I'm going to talk about the principle of this year, and we are already on number two, which is the 3 M's of money. And that I'm going to use the 7 pillars of building generational wealth, which is something I have developed to be able to teach us this, the 3 M's of money. Within these 7 pillars are the 3 M's of money. And these are the 7 pillars. It's got a foundation. You can't build a house without a foundation. So it's got these 7 pillars are sitting on a foundation: your spiritual mindset and your health, your body care. These are the foundation. Upon this foundation, we have these 7 pillars. Okay, and then I will explain each of the pillar, and I will explain the 3 M of money within these 4 pillars. So number one, which is the foundation, is that spiritual mindset. Some people call it psychology of money. Some people will tell you that what determines your prosperity, your outcome in life, is your mindset. So it means you must have a prosperity mindset based on the fact that we are covenant children of God. We carry the blessing. We have been blessed. You have to be comfortable with where there was a time in the Pentecostal in the late 70s and early 80s that we think that holiness is synonymous with poverty. But thank God that perception has been, that was a mindset then, and people didn't want to look for progress. But thank God that mindset has changed. But there's a need for us to further change that mindset that we have right now, because at times we think God is all responsible for everything. Someone said that a faith that puts all the responsibility on God is an irresponsible faith. God has paid his part. Christ has paid the price. We now have a part to play in for us to take action and be responsible for the things that we are believing God for. We always have a part to play when it comes to the blessings of God. Okay, so there's a need for us to have that mindset that poverty is not for us, prosperity is for us, and to say, I know I have, there is resources for me to help myself. There's something called learned helplessness, which is a mindset that people in the midst of plenty, people just don't know what to do. They just resign to the fact that, well, it hasn't been enough, it can't be enough. I've been like this for a very long time. No, you can help. By the help of the living God, you can move ahead and be able to build wealth and retire in prosperity, and also be a blessing to the coming generation. Praise the Lord. Okay, so I'll move on from there. The next foundation you need to have is that of your well-being. While doing this, you want to take care of your body, you want to take care of your spirit, your mind, and your body should be well taken care of, because health is wealth. You need to be healthy for you to be able to enjoy the things God has blessed you with. And so in that process, make sure you have guilt-free pleasure. Enjoy yourself. Your holiday doesn't have to cost thousands. Take time to rest. It could be within UK. You don't have to go abroad. You don't have to go to Dubai or to America to have a good holiday, or just to go just to have a week or two off once in a while is very, very important. These are the 2 foundations. Now let's go into the pillars. The first pillar for us to build wealth, which I know is not need for us, need to us, is financial education. There is a need for us to acquire more education when it comes to financial things. Okay, ignorance is very, very expensive. And people think investment is common sense, and that is the reason why people are losing money. Investment is not common sense. Just like becoming a doctor is not common sense. We have doctors amongst us here, I believe. So you didn't become your profession by just common sense. This is how you just do it. No, you can't build a bridge or design a bridge or design a skyscraper by common sense. You are an engineer. You don't become an engineer or a structural engineer by common sense. You go to school to learn how to become one. And so that's the reason when it comes to your financial education, there's a need for you to be educated in how to invest money, how to manage your risk, how to assess risk in order for you to be successful in building wealth. Don't just throw your money around without, first of all, having the adequate knowledge to be able to do so. And that's one of the reasons why this has been organized for us as Christians, for us to understand, to have some of this education. And you get this education through reading books, attending webinars, attending seminars like you are doing right now, watching a video from people that are telling you what is right. Okay, and from there you gather that knowledge. You don't need to go. In fact, if you go to the university, they probably won't. If you go and read accounting in the university, they probably won't teach you. You go and read finance in the university, they probably won't teach you. Okay, so but you need to go outside of that structure to be able to gain this education. Very important. It must be in place. Financial education must be in place for you to be able to win and build wealth. I listed three very old classic, very good books on finance here. If you read these three books, they are going to change your life. If you read any one of them, you try and put them to practice, they will change your life. I've read them like 2, 3, 4 times for three of these books: Richest Man in Babylon, Rich Dad Poor Dad, and The Millionaire Next Door. They are very, very good books, and there's something, you have the audio version of them. You can also easily listen to them. That's number one. So number two pillar that we'll be looking at is called secure an income. Okay, which is the make money part of the 3 M's of money. Okay, so you first need to secure a source of bread and seed. And I'm sure by the grace of God, maybe we are in one work or the other, whether part-time or full-time, and that is very good. That is giving you a consistent supply of bread and of seed. So the next thing you need to do is to protect that source of income. But beyond that is that anywhere we are now, right now, is a bridge to where you actually want to be. And that will take us to the point that you need to increase your capacity to earn more. The average income in the UK is about 37,000, isn't it? But we know that can't take us anywhere. If you live anywhere around London, you know that the rent starts from 1,000, 1,500 and above to 2,000. And so it means that if we are on 30, on 40, on 50, it can't really take us so far. So there's a need for us to increase our capacity to earn a lot more. Because in this country that we are right now, some people are earning 1,000 per day, some are earning 100 per day, some are earning 120, 130 per year. And in the same country, some people are earning 30 and 40 and 50. Now, not to talk down people who are earning less, but I want us to have that desire to advance and be able to earn more. How do you do that? You go on the least traveled road. Look at a place within your profession that a lot of people are not in. They might say it's very hard. Yes, it is hard because, and that is the reason why it probably pays more. Kindly restate recommended books. Okay, in the chart, I'll just step back a bit for you to see them. If you look at here, you see the three books: The Richest Man in Babylon, George Samuel Carlson; Rich Dad Poor Dad, Robert Kiyosaki; The Millionaire Next Door, written by two PhD holders, professors. Very good research on American millionaires. Okay, and so there's a need for you to look at a place. There is no career in the world that has not made a millionaire and that cannot have the capacity to make a millionaire. What you need to do is to look at a niche within your career where you can target or if there's a need for you to do a change of career, make a change of career. There's a need for you to negotiate better pay, negotiate better. When you're negotiating better pay, you have added value to yourself to be able to do that. And that is what increasing your capacity to earn more is all about. And I'll show you a familiar journey with a lot of us in the UK. And I've gone through that same journey of starting as a warehouse operative years back, moving into healthcare, moving to support analyst, moving to DevOps, and moving into being a business analyst, and then from there moving to become a consultant, and then moving on now to solution architect. So it's been, for instance, my journey of increasing my capacity to earn more. Okay, now moving from a 6 hour years ago to whatever I'm earning right now. What am I saying? Keep moving. Don't settle. Don't settle for less. There could be a need for you to push yourself a little bit more, but it's going to worth it. It's going to worth it. So remember to keep moving. Very few ways. Okay, now, in addition to you now increase your capacity to earn more, it's the fact that do not also forget that just working 9 to 5 might not make you worthy. There's a need for you to now take from that the seed we talked about and do something about it, making your money work for you 24/7. So that's the second pillar. So pillar number 1, if you're not forgotten, is financial education. Pillar number 2 is making money or increasing your capacity to earn more money on a consistent basis, consistent personal development, or it could be an additional thing that you can do on the side, okay, to be able to increase your capacity to make more money. And the third one, which is the second aim of money, is to manage money. And this is one of the most important point I'm going to make today, that it is not about how much that we earn that matters. It's about how much we can put what we earn into use. That's what matters. You're going to be earning a million pounds per month or per year. It does not matter. A lot of people earn a million pounds per month are very broke people. If you give them 30 to 90 days, if they're out of their current job, they will be as broke as anything. So it's not about how much that we earn. People will think if I double my salary today, I'm going to be better off. You might not be better off until you understand what this statement is saying. It said, what each of us calls our necessary expenses will always grow to equal our income unless we protest to the contrary. It means what you think is your necessary expenses grows as your money grows. Okay, when you were earning 2,000, you remember it wasn't enough, but you are on 4,000 now, isn't it, per month? And it's still the same thing. It seems as if it's still not enough. Or you moved on to 5,000 every month, and it's like it's still not enough, or 6,000 every month, or 7,000. It's still the same story. This money is not enough. Why? Something has happened. Lifestyle creep has happened. As we earn more, we tend to convert our discretionary expenses to non-discretionary expenses. We tend to convert our non-essential to essential. We tend to start seeing luxury goods, luxury living as if it's a necessity. Okay, whereas it is not. So there is a need for us to prevent what is called lifestyle creep, even as we continue to increase our capacity to earn more. So the more you earn, you need to protest to make sure your income does not equal to your expenses. And how do you do that? You do financial control through strict budgeting. You have to be strict with your budgeting and becoming debt-free. Those two things is what will help you to control and manage your money. We're still going to go out to multiply money, but I want to emphasize this very well, that there's a need for us to be able to do budget and stay with that budget and also work our way to becoming debt-free. Is it possible? Yes, it is possible to become debt-free. Maybe outside of your mortgage, maybe credit card and personal finance and car finance, it is possible to be totally debt-free in that area. And you work towards finishing your mortgage in 15 years, even if you want to start, follow the things I'm going to talk about today. And so that have a 2 to 3 year plan to become debt-free. And then how do you become debt-free? You just have to say, today is the end. I will not borrow an additional loan. And what do I now need to do? You now need to have in place a budget that will help you to say, this is how much I earn, and I'm going to live within my means. So nobody can do that for us. We have to make that determination to say, I won't keep using my income to service loans and credit card. When you do that, it significantly reduces your ability to be able to build wealth. And that is just the same thing. I read the statistics not too long ago about America that about more than 30% of Americans who earn $250,000 per month says it is not enough for them. And these are people who earn $250,000 per annum, rather $250,000 per annum. More than a quarter, more than 1/3 of them says they are still broke. Okay, so it's not so much about numbers. So the issue of whether we have enough or not enough is not so much about numbers. It's about us being able to put control in place. So speaking about budget, you look at 50% to your needs, 30% to your wants, and savings 20%. This is just a rule of the thumb. It's a general rule that you tend to have out there, but the numbers could shift around a little bit because people who live around London, for instance, your housing will be a lot more, and that will eat into your wants. Your other things could be a lot more expensive, which will eat into your wants. But generally, where I'm going is this: do not leave this place empty when you're doing your budgeting. There must be something in your savings and your retirement outside of what is being taken into your workplace pension. There must be something else. If the slice is 5%, or the slice is 10%, or the slice is 15%, or whatever the slice is, at least 5% to start with should be going into savings and retirement. So I gave an example of here where somebody is earning 5,000. This will probably be around 1,500 because I have a house around Evely in South Ockenden. I have a house there. I used to live there. It's renting out now for £1,600 per month. It's a 3-bed terrace, and if it's that expensive, so by the time you look at it, you might be allocating up to 60% here, okay, for or more for your need. You let it come from the blue area into the green area, which is the things that you must spend money on. What are those things? Your rent, your child care, your living expenses, your transport, your giving. There are things. Other things are things that you can flex around or that are avoidable. Some things are not avoidable. You need roof over your head, you need food in your stomach, you need to take care of children, you need transport to work. All of those things are things you can't avoid. But what I am for is that do not leave your savings and investment empty. Let it be the first thing you take out at the beginning of the month. I tell people that I coach that say, no matter if it is £100, if it is £200, before you know it, I have an account that I put £250 into on a monthly basis. After 2 years, I look at that account and I can't believe what I have there. And that is the power of consistency. So it's not so much, like I said, about how large it is. It's all about how consistent and how well you are able to manage it. Financial control, if it is 3,000, you look at something like this. Okay, this is just an example, looking at the 50, 30, 20 rule of financial control. And so the next pillar we are going to look at is that of strategically building wealth, and that is how you multiply money, which is what we're going to spend the rest of this training on after finishing the seven pillars. Multiply wealth. So automate your savings, and that's the first thing you do. A part of what you earn is yours to keep. That is the foundation for you to multiply wealth. You need a seed. Remember at the beginning, you need a seed to plant. If you don't have a seed to plant, if Isaac ate everything and didn't have a seed, when God said stay and plant, he would there would be nothing for him to plant. Everyone else they've all eaten what they had, and so he was the only one that had a seed left to be able to go and plant. And God blessed and prospered what he planted. So what am I saying is that a part of what you earn is yours to keep. This is a quote from the richest man in Babylon. It's a part of what you earn is yours to pick, and that is what we now call pay yourself first. When you hear from people, they say pay yourself. What does it mean? Pay yourself first means that when you are doing your expenses, when you are doing your budgeting, your name should be at the top of that expense list to say, pay myself 5% of my income, and that goes into a savings account or into an investment account. And that is when you are actually rewarded your tomorrow and yourself. Okay, and like you said, avoid personal debt, and then you can build wealth in different ways. We have listed 3 ways here through which you can now multiply money. I will go through the remaining pillars, and then we'll go back to multiply money, and I will explain that in details, because I think that is the main reason why we are here. Okay. The next thing is wealth preservation, risk management. Very, very important that you must have that pillar in place where you have check and balances to know what investment can I go into, what is my investment philosophy, what can I do, what can I not do. When somebody says, oh, I have this deal somewhere, you know what, in 6 months your money is going to be 100%, your risk management antenna should go up to say, what are you doing in 6 months to multiply to have 100% increase? Then you become very suspicious. So you are able to manage risk. You know what it is you want to put your money into. You know what you cannot put your money into. You know, understand diversification. You understand balancing of your portfolio. You understand a lot of things about risk, and that's a pillar we must have in place at every time, every point in time. Again, tax advice is very, very important. Know the country we live in, that the exchequer or the taxman is after your wallet at all times. Even when one retires, they ask after your wallet. Even when one passes on, they are still after your wallet. So there's a need for one to understand how to preserve wealth. And the next part is how to transfer that wealth, which is succession planning, to be able to educate the next generation, know what will, how to put together a will, trust, shareholding, family office, to be able to successfully transfer whatever you have built to the next generation in a very tax efficient way. They will still get something, but in a very tax efficient way. It's another pillar that you must have in place. We need to educate ourselves on all these pillars. And the number 4 pillar is the charitable giving to the things of God, giving to causes that you know, to causes that touch your heart, you know. And then I said there's blessing in giving. When you give, you lend to the Lord, and when you do so, God will reward you powerfully. So we've quickly gone through the 7 pillars of building wealth, and these are the pillar that 2 foundations, 7 pillar upon which that wealth for generation stands. Okay, and so I'm going to move on from there. I will now go back to how to multiply wealth. That will be the next thing we will be looking at. But before we go into that, I'm going to play another video. In this video, I will share the audio so that you can hear the audio, unlike the last one that I didn't share the audio with us. You hear my voice in this video, and then I'm talking in it. You hear me talk about different social stratas or different levels. It's more like a pyramid level. Or okay, and in fact, there's a need to refine that concept. But let's have a listen, and then you see where you belong. So where are you within this particular triangle? Okay, I'll play now.
I want to quickly share with you a concept I learned during the week called Pyramid of Wealth by Dr. Olumide Emmanuel. The base of this pyramid are those who are in financial crisis. This level represents those who are without any source of income. They depend on handouts and generosity of others to survive. And next to these are those who are financially unstable, who have a source of income, but their take home is not anywhere close to what they need to meet basic needs of life. They live perpetually on personal loans and credit cards in order to augment their income. And next to them in the middle are those who are financially stable. These are the middle to lower upper class people. They have good jobs, they earn decent income, they drive good cars, they probably have a house on a mortgage, they can afford to go on holidays, etc. These are the most deceived set of people in this triangle, because if they're out of job, they become financially unstable within 90 days. They have little or no savings, no income generating assets. They are actually 60 to 90 days from becoming homeless, because the banks will come after them in no time. A lot of the so-called big boys and big girls are in this category. And number 4 in the triangle is financial independence. People at this level have enough assets to take care of their needs. They earn passive income from businesses and investment that is equal to or more than what they get from their day job, if they still have a day job. They can choose not to work anymore. They have time freedom. And at the peak of this pyramid is financial freedom. At this level, you can take care of your needs, and want and even take care of thousands of people. You can make impact at a larger scale and give away millions and billions without stress. Which level are you? In order to move from one level to another, a new body of knowledge, a shift in mindset, and association is required. This got me thinking, and I'm hoping to double my efforts so that I can exit the just financially stable level and make greater impact by the grace of God. So I know I need to read more books, get more trainings, and build new connections to make this happen. So help me God. I want to quickly share with you a concept.
Okay, I'm going to stop that now. I think we've listened to that. Interesting, isn't it? And to be honest, I like I said in that video, I recognized that we talk about financial stability, and you think everything is hunky dory and everything is okay, but is it actually? Is it actually? How many days are we, if God forbid one is between job, how many months away, how many days away are we from, being from the bank coming after the car and coming after the house? Okay. And so that is why there's a need for us. It's a wake-up call for every one of us to say, no, we deserve better, and there's a need for us to do better and to be able to take some of these things very seriously and be able to look at how we can start to multiply money using asset producing. If you look at the financial freedom part of it, say you have income producing assets, okay, that is almost equal to your current income, and that is when you are becoming financially free. Okay, and that is the place where you want to quickly move on to as soon as possible. So when we talk about, I've been talking a lot about seed. Planting your seed equals to investing your income into investing in income generating assets. An asset puts money in your pocket. Liability takes money out of your pocket. And you know that when you just bought, if you just bought a brand new car, and as soon as you drive it out of the parking lot into the main road, that car drops in value by about 15%. If you drive it back the following day to the garage, they won't give you your full money back because it's already second hand. So by the time they want to resell it, it's got one owner already. Anybody buying is be the second owner, and so the value of that asset has reduced. In accounting, a car is an asset, but when we talk about investment, a car is a liability because it takes money out of your pocket. It's not putting money back into your pocket, or else unless it's being used for Uber, and that Uber is able to pay the monthly the monthly hire of the car and put much more money into your pocket. Okay, and so let's look at it. Asset classes. So we are now on multiply money. 3 M of money: make money, manage money, multiply money. And so this is the third M, which is multiply money. I've gone back to that after finishing the 7 pillars of building wealth for generations. And so these are asset classes into which where you can multiply your money, okay, over time. You look at all of them. The ones in green are the ones I'm going to quickly talk about. There are 6 major asset classes. You have equities and stock recognized all over the world. You have fixed income or bonds, cash and cash equivalent like treasury bills, like a certificate of deposit and treasury notes. And then you have real estate. You have commodities like gold, oil, and the rest of them. And then you have alternative you have real estate, and then you have alternative investment like you starting your own business or buying your business or buying a business that's already profitable. All these are ways through which these are asset classes through which you can multiply your money. They are income generating assets. Investing in commodity, maybe precious metal, might not generate monthly asset for you. For instance, if you buy a bar of gold, for instance, that bar of gold might not generate money for you, but it could increase in value. But the remaining one are income generating assets. Okay, so let's go into the ones that we'll have enough time to go through this evening. Building wealth takes time. Looking for shortcuts will lead to bad financial decision. That's one I want to put out there. Building wealth takes time. You don't just it doesn't just happen unless you win the lottery. And when you win the lottery, what have you done? You become very rich. You are not yet wealthy. If care is not taken because you do not understand the principle by which that money got to you, A lot of people who have won lottery in a matter of a decade, half a decade, they usually lose everything. Why? Because the knowledge needed to multiply of that money is not there. Okay, so building wealth takes time. And so the first thing we'll be looking at, so we look at, we say asset classes. So we're going to look at ETFs, mutual fund combined with stocks as one. They belong to the equity class, and then we look at the real estate class. The other ones are there. I might be touching on them as we go, savings and other things. I can touch on them as we go, but those are the two areas in which I will focus when I talk about investment in shares and stocks, which is one of the most popular ways of multiplying money. I'm not talking about crypto. I know that there could be Gen Zs, a lot of young people on the call tonight. I'm not talking about, we don't do training on cryptocurrency. I own some cryptocurrency. I do that out of curiosity and the fact that, well, it's that amount is not compared to what my investment is. It's not 0.0 whatever percent of what my investments are. And it's not about day trading. I'm sure day trading is very popular in London. I worked in central London for many, many years. We used to go to IG office for free training every evening. We go to meetups every evening to go and, listen to people. I used to trade. I started trading from 2006 to 2012, 2013 thereabout, and then I stopped trading. Trading is very risky. I lost money, and trading is very, very risky. When I'm talking about today is you becoming shareholders of reputable companies or across the globe, in Australia, in Asia, in Africa, in United Kingdom, United States, North and South America, across the world. Europe, mainland Europe, is for you becoming a shareholder of such company. That is what we are talking about tonight, not day trading. Okay, day trading is not passive income. The day you don't trade, you don't make money. Okay, and then it's very high risk. Over 70% of people who trade in the UK lose money. Over 70%. Fact that over 70% lose money. You might be one of the 30% that will not, but I doubt a lot of us. Probably I'm not one of them though. I don't know about you. Okay, if you have any questions as you go, please don't hesitate to drop in the chat. I will attend to your questions. Okay, so a person who is a shareholder, somebody you got a little piece. This is a big cake. Okay, and then they've cut for you just a tiny piece of that cake, and then you become a shareholder of the company. You have rights and responsibilities. You have rights to vote, and then you have also rewards and benefits from the company's success. This company are called public limited company. They are listed on stock exchanges across the world, and then you are able to connect to stock exchange these days through a app on your phone. Okay, you do not need to call anybody, go to a stockbroker's office, or phone anybody, transfer money to anybody to be able to participate in this global economy of being shareholders of company through a app on your phone. You can now connect to exchanges or stock exchange all over the world, and then you are able to transact, buy and sell equities. And these are the things that you can do when you are in stock exchange. We have the individual stocks, which are stocks of companies like Microsoft, like Apple. I'm just giving that as an example. I'm not saying they are the things to buy, but they are things, just an example of Tesco, of Lloyd's Bank, of HSBC, and the rest of them. And then we have mutual funds. They are baskets of individual companies put together into one. That could be 100 company as a basket. Then there will be a price tag on that 100 company, and then you can, when you buy that mutual fund, you are buying into the whole of the 100 companies or more. That is 500 companies, that is 50 companies. Okay, trust fund is similar to mutual funds, but the structure in which they structure them is slightly different. Then ETFs or exchange traded funds, which a lot of us are very familiar with. If you have money box and the rest of them, you probably have a lot of ETFs in your account. These also are similar to mutual and trust fund. They are baskets of funds, but these are traded on a daily basis. The price will change even as the market opens and stuff like that. We have these ones, they are settled at the end of the day. Okay, we have the index fund or tracker fund. This track a particular index. I will explain what index is as we go. We have bonds. Bonds is when you borrow corporate organizations money, you can borrow Lloyd's Bank money, and then they give you interest on which is the coupon rate. They give you interest maybe twice. They give you money twice in a year as yield on your money, and it could be with them for 10 years, it could be with them for more than that. And then at any point, some bonds you can sell in secondary markets, some you cannot sell. Then we have futures, derivatives, and currencies. All of this I've cancelled it out because this has to do with trading, and I do not personally do not advise us to trade. I don't do that anymore, and I don't advise us to do so. Okay, so why the stock market? There are trillions and trillions of sovereign funds, money all over the world are invested. Your pension fund that you are contributing at work, a bulk of it ends up in the stock market. Okay, and the one in America is the largest with about more than $45 trillion in it, and out of the $60 trillion of pension money in the world, a chunk of it are in real estate, private equity, bonds, and the stock market. But the reason why I love it so much is the fact that anybody can participate. Your teenager can participate. That baby can participate. You can open an account for that child today, and then they will thank you tomorrow. And anybody can participate. With £1, you can start investing today without leaving the comfort of your house. They made it so simple. There's something they call fractional shares. Before, you need to be able to buy whole share. For instance, I think Microsoft should be around maybe 400 or 300 and something dollars per one share now. It means if you are saving to 200 every month, you need 2 months savings to be able to buy one share or so in the past. But today you can buy £5 worth of Microsoft shares. You can buy £10 worth of Apple shares, or £1 worth of any of these shares. So it makes the market open to everybody to be able to participate. Now I'm going to go on to explain the best way for me to explain how this works is to explain the power of compound interest to us, to say, how does this really work? There are two things that you gain when you invest in the stock market. One, capital appreciation. It means you can buy a stock at $100 per one and it become 120 over a period of time. Okay, you could buy a company that pays dividend, and that dividend could be 5% or whatever you bought, or could be 10% return on your money. And so as the company is appreciating and they are doing good in the society, for instance, we all use Microsoft product. For instance, the system I'm talking on right now is a Microsoft system. The hardware is Microsoft, the software is Microsoft. Maybe you also have an Android phone or Apple phone or whatever devices you are working on. These people are making money doing all these things, and so they share part of their profit with people who are shareholders. So you can have dividend from them. Someone said that compound interest is the eighth wonder of the world, and I agree with them, because it does phenomenal things if you understand it. So if you don't understand it, you pay for it through credit cards and loans. If you understand, you earn it through interest and through capital appreciation. So I love to simulate this. I'm going to put this link in the chat. The link above is a compound interest calculator. So going to give you a kind of idea of what is possible when you invest in the stock market. Okay, so what I have here is that, let's assume you have a child who is age 0 today. You put maybe £100 or £1,000 in an account for them. On a monthly basis, you put into 200 at a return of 10%. Over 18 years, that money will be £126,000 in that account. I will simulate that for us. It could be any age, it could be any amount. You can vary the amount, but I've used 10% because this is the average return over a long period of time that you get when you invest in stock market. But we always say that past performance is not an indication of future return. But again, I will say that the history is on our side, because for the past 70, 80 years of the stock market, especially the S&P index, it has returned between 9 to 10% over 7-8 decades. And so looking at that, it shows that the history is on your side, that you should be able to achieve something close to this conservatively, even though no matter what has happened, whether market is up, is down, that could be here when it will do 30%, 40%. That be here, like last year I had about 35% return. That could be here when it will do 40%. That be here that we need to do minus. By the time you average it, you should at least have a return of 10%, which is a lot more than what any savings account will give you. I'm targeting a return of 15% on the average per month, per annum over a long period of time. So I'll put this in the chat and then we'll just take a look at what that simulation will be. You might not see anything on my screen right now. I'm just copying that link to give to us in the chat. Okay, I'll put it to group chats to everyone, I believe. Yes. Okay. So, and I also put it into my browser so that we can all see that simulation together. Okay, I'll go back to sharing my slide, but I'll bring up my browser. Okay. So I'll bring up my browser. I'm going to put the same link into my browser. Being mindful of time. Okay. Okay. So I'll just do a few simulation with this, and this is just to paint a picture for us for what is possible, and this will involve patience and time. So you don't need to start with 1,000. If you have £100 you are starting with, and this, for instance, for that child, if you do that and you do 200, okay, for a period of 18 years, when they are off to university, what do you have? You have 120,000. So what you actually put in is 43,000. That is what you put in. You started with £100, okay, you put in 43,000, but what they have, you earn an interest of about 77,000. That is you multiplying your money over a period of time. If you look at it, that's the way the money has grown. And let's assume, and what can they do with this? Like I tell people, they can be a deposit for them to buy a house anywhere they are going to uni. It could be for them to go to school free without having to go and loan money from the student loan. Okay, and if they don't want to touch the money and they leave it until they are 45, for instance, at the age of 18, 20, they take over the account from. At the age of 18, automatically they take over the account from you, and they start putting money into it themselves. Okay, and you don't have to. You only bother for the first 16 or 18 years of. By the time they are 45, they're already ready to retire. They don't need to wait until they are 60 or 70. And this is us giving them a good pedestal for them to stand on. Okay, let's assume, okay, thank God for the children. Let me take care of myself first. That's also okay. So if you want to look at it, let's assume you are 30 right now. And then you do the same thing, but as an adult, I will expect to do more than that, and you do that for the next 35 years. Okay, what do you have? For 35 years, you also have something very comfortable to retire on. When we're talking about comfortable retirement to be about $500,000 as it stands right now, you're already having like $1 million to be able to retire when you turn 65. You're just starting at the age of 35, and then it depends on how much you put in. For me, for instance, in my family, we've put in almost £2,000 every month. So it depends on your target, because I started very late. My story is that when I was 40, at age 40, I had less than 6,000 in my retirement account in this country at age 40. And I said, no, I have to do something about it. I'm not getting any younger. I'm 40 with 6,000 in my pension pot. I have to do something about it. So aggressively, by the grace of God, by the time I'm 55, I should be ready to retire. Okay, that was because I did. So it depends on how much you are able to spare. It could be, if you say, okay, 65 is just too old. Why can't I? Oh, I've not been charging my laptop. Sorry. So why can't I just retire a little earlier? If you want to retire a little earlier, it just means that you have to be able to put in more, or it could be that you get better interest or better return on your investment. So it all depends. Okay, so you can move around the figures as you wish, and that will give you the number that you want. So I want us to play, apologies for that. I want us to play around with that number. It could be, so the other part of it, this which I would do for the sake of time, is that let's assume you are at age 65. Let's start for somebody who are like myself at the age of 40, and if you want to retire at 65, so that's 20. If you started at the age of 40, and that's you have 25 years to be able to do that, I will expect to do more. But even if you can't do more than that, what will you at the age at that? You have something close to 400,000. If you are consistent with 300,000 every month from age 40 to age 65, you still have something very decent. You remember that probably you already have a house, you already have a bit of a workplace pension. All of that put together is already getting into the millions. Okay, and so that is also a very good place to be. But let me go back to that previous example, and what I want to do there, sorry, I've lost that page. Okay, I'll do that again. 100, and we say we said this should be 10, and then we said 35 years, and maybe you are putting in 300. So what I want to do simulate here is when you retire and you are making a withdrawal of what you have there. So let's assume you are now 65 years old and you have 1142255 in that account. That is 1.1 million, 1.1 million pounds in that account. So that account is giving you a yield of about 10% per annum. Okay, at that point you start moving your asset into less riskier, maybe bond that can give you 10%, or bond that can give you 8% or more, or on a yearly basis. And then from age 65 to, let's say, you age 40 and you are now 105-year-old. Okay, so at that point you don't deposit anymore. What you do is you withdraw. Let's assume you are withdrawing a decent 8,000 on a monthly basis, which is a lot for a pensioner, especially when the children they're already out, they've gone out, they've flown, they're already out of the nest, and then you have your mortgage paid off. What will you do with 8,000 every month? If you do that, at the end of that, by the time you are 105, you still have like 10 million in that account. And what is that? It means you are spending the interest on your money. Your interest is 115,000 on a yearly basis, and you are only spending 96,000. This a lot of money for you to be in retirement and be earning 96,000. And so some people, you can probably earn more money in your retirement than you are earning when you are actually working. If you plan this very well, you can probably earn more money in retirement than you are earning while you're working. And if you do, there's an account that you can even access. It means you can probably retire a lot earlier than planned. And this is the simulation. So this is an example of what is possible with a conservative 10% return over a period of time. This is possible. If it not be possible, I won't be sitting here saying what I'm saying. I've done this for more than, minus the years of trading, proper investing, for more than 7 years, and I can assure you that of where I've moved from that 6,000 to where I am right now is a way, is a long way off from where I started, and I can attest to what I have on the screen. So what I'm going to show us next is to show us actual return of companies in the market. So I've chosen a few companies. I'm going to put these two links in the chat for us. We can play around with it. I will share that screen so that I can get that link into the chat for us. You can use any one of them to simulate what I want to do right now. And what I'm going to do right now, I want us to participate in it. Tell me companies, tell me the name of companies. Tell me the name of companies that, let's assume that you have some spare change today to invest, or you want to start investing today, or you want to start, or maybe 10 years ago you want to invest. Tell me the names of some of the companies that you probably might buy their shares. You've seen this company around. Let's assume I want to go back 10 years now. I want to look at the last 10 years. So the 1st of June, 2014 till date. Let's assume you have 3,000 to put in company. Put in the chat for me, please. Put in the chat for me. Give me the name of a company. I will type it here. Or a company that you probably would have bought their shares like 10 years ago. Okay, I can see something in the chat. Let me see what someone said. Meta. Okay, let's see Meta. Thank you, Obi. Sorry, Sister Obi. Meta. Okay, Meta platform is the owner of Facebook and Instagram and the rest of them. Okay, let's look at what that will give us. Let's look at that will give us. That will have given you 23,000. How many of us had a spare 3,000 a few years ago? So, and this is passive. This is you not doing anything. You put 3,000 into Meta 10 years ago, and then you just throw away the key, and then you log in today, and this is how much you will sell your shares for, and you can withdraw that money within the next 2 or 3 days. Okay. And with the kind of account that we are going to that would explain to us, you don't have to pay tax on this money when you get it. That's the sweetest part of it, that you can do something in this country without paying tax. It is sweetest part of this that I can show us. Okay, so you have 22%. Remember, I used 10%, 22% return on an annual basis. Someone said Tesla. Okay, let's look at this. Tesla. Let's look at that's an electric car company. If you do that, if you do 10 years ago, that will have given you 42,000 that will be in your account. It's an average of 30% return on that particular company. Someone said Coca-Cola, and that's KO. Coca-Cola company will not give you that much, but let's see what it's going to give us. It will have doubled your money. An average of 7.9% is what Coca-Cola will have given you on a yearly basis, consistently. Remember that savings account 2-3 years ago was giving 0 point something. And in fact, I had lost account, they didn't want to give me anything at all as interest. But this will give you consistently 7.9 over that 10-year period. Well, on top of your 3,000. Someone has put in MSFT, which is Microsoft, which we know they are very popular with their product. That will have given you a decent 28% return on a yearly basis on your. So what will happen is that some of them will give you minus. Let me look for anyone that might give us a minus. Johnson. Let me check Johnson. Even though they are very popular company, let me see what it will have given us. 5,000. What can give me negative? What negative? What about General Electric? Some old companies that have been around for a very long time, okay, that will only give you this just 3%. So there are some companies that will not give you 10, 20, 15. Some might even give you like -2, -3. But some of those that gives minus, they pay dividend. They will like be giving you maybe 3-5% dividend on a yearly basis, which will probably compensate for them not growing. They are no longer growth companies. So when we go deeper into this, there's company they call growth company, speculative company, and then we have the ones that are not growth company. They just pay dividend. Okay, so they are different. So by the time you have a mix of all of this in your portfolio, at the end, you get to average 12% or 15% or so. Worst case, 10%. Okay, over a long period of time. Like I said, history is on our side if we were to look at it. Okay, so those are the things that are possible. Okay, there's some other companies that I have on that list. I have okay, someone has called Facebook. I have Netflix. A lot of us have Netflix subscriptions, so I like to use the things that we spend money on a. I normally joke with my wife. When my wife is shopping from a company too much, I'll go and look at their stock. I likely buy their stock. When she was shopping, she doing a lot of shopping from Next. I own Next stock today. My Next stocks is doing very well. I think the little money I put into Next, I've made like 26% on it. Next Doco.uk on clothing. And so Netflix will have given you that. We use Netflix. And there's a company that you use every day that you might not know. It's called NVIDIA. NVIDIA. Okay, NVIDIA would have given you 800,000 on your 3,000. And to be honest, Amazon. Okay, let's look at Amazon. We also all buy a lot of things from Amazon, and someone that's also put in Apple. Okay, that will have given you a whopping 74%. And this, the reason why this company I've had this company for 7 years. I've made over 1,000% on this company. And so this is no joke. I've made over 1,000% on this company in the last 7 years. And the mistake I've also made is I've sold, as the thing was going up, I was selling it because I said, this thing, I don't know whether this company will always be very good, but it has been consistently good. And why? because what they produce is they produce things that the servers and computer use. For people who are playing games have become very popular. They do graphic cards for games. But when they start mining cryptocurrency, they are the one that produce graphic cards for cryptocurrency. Now we are talking about AI, that the one producing the hardware and software for AI. So consistently they've been making money from everything that is happening in the economy. Okay, and that is why it is like that. So let's look at Apple. If I'm not sure a lot of us use Apple phone, what would have Apple given us? Apple will have given you 31,026% return, which is very good. And Amazon, which we all do that click next day delivery from, will have give you 37%, 37,000, which is 28% average on a yearly basis over the last 10 years. Okay, I hope with this little point of mine, I've been able to convince you that you could get at least 10% return on the average from the market. So someone said, kindly share insight about this investment, Vanguard. Okay, I will get there in a moment. Okay, I will answer I will explain those three in a moment. So yeah, so S&P 500 is where I am right now, part of your question. S&P 500 is an index, okay? So you could get an ETF of that index. So this has been the return of S&P 500 since 2010 to 2024. Okay, 2024 so far, probably I'm sure it's already more than this. But if you look at it, you can see it has a consistently return. And even in the year when there was COVID, it still returned. Only the year when we have inflation that it returned -18. But you can see it recovered immediately the following year. And the average of this, if you look at the statistics I have to this side of the screen, says last 25 years it has been 9.3%, last 10 years 13%, okay, and the last 5 years 11%. In the entire history, that's 95 years history of S&P, we've had a return of an average of 11.2%. So that is the basis for my 10%. And you now say, if you observe the win, you win also. Because when people see things, the way the market moves, I don't understand though, it has crashed though. No. For people, I think for people, by the time I explain this deeper for you in my master class, you see that what people call crash is not a crash. It's called a pullback. There are pullbacks, there are corrections, there are crashes, and there are what is called the bear market. So the things you see when you see a red candle or whatever you see, they say the market is down today on CNN News, is called a pullback. It doesn't go on a straight line, it goes this way. People buy, people sell, people buy, people sell, people buy, people sell. And so that is normal for the market. But at the end of the day, you have to look at a long horizon when it comes to investment. So you look at that, S&P 500 will return that. And I'm sure the person asking the question is probably asking about ETF or an index tracker that tracks S&P 500. So this S&P 500 is a summary, a basket of the top 500, about 505 companies in America. They are the largest company by market capitalization in America. 500 of them put into a single basket, and then you can invest in all of them by just buying a single share that would invest in all of them together. And that is the kind of return that it has given them. Another one called NASDAQ. NASDAQ is a stock exchange, but we also have NASDAQ 100, which is summary of top 100 companies within the NASDAQ stock exchange. Just like you have London Stock Exchange, there are two exchanges that are popular in America, the New York Stock Exchange and the NASDAQ. NASDAQ and then the Dow. The Dow also is also another index. So it's not a stock exchange, it's an index. So we now have this, which is this NASDAQ 100 is company within NASDAQ minus the financial companies. So we have a lot of technology company within NASDAQ that has returned in 25 years average of 16% because it's technology. Okay, then 18% in the last 10 years. Then we have Dow Jones and manufacturing sector. You can also have an index of this. You can also have an ETF on this or this. If you look at this particular website, which you can write down. You can go and look at, you can go and simulate year after year to see what they've done in the last 10, 20, 30, 40 years. Okay, that is the source of the data you have on your screen. And so that is the historical performance. But like I've said down here, historical the performance quoted represents past performance and does not guarantee future results. But again, look at the history. I will not say more than that. So these are the things we hear in the news. Oh, there's Ebola virus, there's any recession, there's Brexit, there's trade war between US and China. Okay, and there was and then you have what year is this? You have here, this is coronavirus. Okay, you have a lot of things happening in the world. You have 2022 increase in interest rate. But if you look at the market today, it's probably somewhere up here. Despite the noise in the market, S&P 500 keeps moving up. And these are the reasons why people say, I want to wait for a good time to invest. There are no good times. There is no good or bad time to invest. You need to start where you are and start now. And over the period of time, consistently over the period of time, you will see the results. So let's go to the account that we can open. So in that chart, you said Vanguard Trading 212. Yes. Okay, so this is where I will soon explain what that is all about. So these are the accounts that are government recognized. Okay, there are more than this, but these are the ones government recognized and they are very beneficial to us. So I've filtered out the ones that I think we might need. Okay, the first one is what is called a junior ISA. And mind you, when I'm speaking here, I'm speaking about stocks and shares and stocks. There are cash equivalent of these ones that you can walk into a Lloyds Bank, HSBC Bank, Barclays Bank, and open a cash ISA, okay, or a cash LISA. Okay, but anything I'm talking about here, I'm talking about you investing in the stock market. Okay, junior ISA. Okay, junior ISA. Okay, I have to run a little bit quicker so that we can finish this. Junior ISA is for age 0 to age 17. You can, as parents, you can put in there up to 9,000 in the tax year, April 6 to April 5 every year. Any profit you make on that is tax-free. Okay, when your child turns 18, they take over the account. And then you can start with as little as maybe 50 pounds today with some companies with some platform I'm going to give to us in the next few slides. Okay, for those who are under 40, and I'll tell you, if you're under 40, go and open this and put £1 into this, and then you come and thank me later. If you're 18 to 39, you can open a LISA, stock and share LISA. I'll now show you the companies that will allow you to open that. Okay, on this, you can start spending the money. You can withdraw the money to buy your first house, tax-free, okay? And then government, or leave it until you are 60. Government will add 25% of any amount you add into the account. Government will give that to you, okay? And then you can put in a maximum of 4,000 into the account. Mean that government can give you a maximum of 1,000 within a particular financial year. You can't use the money for your first house until you've opened the account for at least 12 months, after which you can buy the house. The house cannot be worth more than 450. They should increase this for people who live around London so they could also enjoy, because houses in London now are a lot. The average is getting to that particular amount. Okay, and then if you leave that money when you are 60, which the reason why I said is good is because if you already have your house and you are less than 40, you can still open it. Or if you don't want to buy a house with it, you can still open it, because it serves as a retirement account for you. You can't touch, if you touch it, you'll be penalized. They will get their £25 back, 25% back from you. So it's better you just use this, because that restriction is there, then it can serve as a retirement account indirectly. And then you don't have to pay tax when you retire. Okay, but for every other retirement account you pay taxes, but for this it could indirectly serve as your retirement account, and then you get 25% free from government every year until you turn 50, and you don't have to pay tax when you turn 60. They might increase the age later, I do not know, but for now it is 60. Junior SIP is when you open a retirement account for a child. But that child can't touch the account until they are 55. The age is also going up to 57 very soon. You can see they keep pushing the boundary. They keep pushing the boundary. And so it means one have to look for you have to plan your own exit out of the 9 to 5. Okay, so age 0 to age 17 can open this. When they turn 18, they get it. They can take over the account as their own retirement, personal invested, self-invested personal pension when they turn 18. You can give them up to 2,880. Government will add a 20,000, 20% to it to make it 3,600 on a yearly basis. Or any amount you had, you put in at all, they give you extra 20% on top of it, and that is them giving you your tax back more or less. And then we can go on to the next one. When they get to 55, they can withdraw 25% of it tax-free, but the remaining portion will be taxed as they withdraw it, depending on the tax bracket in which they find themselves. The ISA is for anybody above 18. Okay, and then you can put up to 20,000 across all your ISAs. You can open multiple cash ISA. Now the law has changed. Before, you need to transfer your ISA from one bank to the other or from one investment company to the other. Now the rules are changed. You can now open multiple cash ISA and multiple shares and stock ISA with different platforms. You are able to do that right now. But across all your platform, including even your LISA, you can only have 20,000. There's a new rule that is introducing an additional 5,000 to make it 25,000, but they've not fully implemented that yet. You can now buy British stocks with additional 5,000. That is not in the market yet, but for now, 20,000 you can spread across all your ISAs. ISAs are also tax-free. So if you can be disciplined not to touch, but ISA, the disadvantage with ISA is that you can touch it, you can buy, you can dip your hand into it and use the money at any time. So it's difficult to make a retirement account because things will come out that will make you touch the money for whatever reason. But the good thing is that I think we put money out of our ISA to buy house before, which is a very good advantage. If you have it, you can sell anytime and pull out money to do other investment. I don't sell an investment to spend. I sell investment to put into another investment. So into, and if I in the house which I'm sitting right now. Okay, so we have SIP. SIP is a retirement account. Okay. And that is you doing this in parallel with your workplace pension. So there are interesting figures here that when you start a SIP, government can give you up to 45% of whatever you pay into your SIP. So if you put in £100, government can give you back, they give you an additional £45 back, which is the tax you've already paid on that particular money. It's given back to depending on the tax bracket that you have. If you're a basic taxpayer, they give you 20%. If you're an higher rate taxpayer, they give you 40%. If you're an additional rate taxpayer, you get 45%. You can claim the 20% here and 20% here. You claim it back through your self-assessment. But this 20% will be automatically added to your investment account. You don't need to request for the first 20%. Just like every other pension, you can't withdraw from it until you are 55. Age is going to 57 by 2028. And across all your pension accounts, you can only put £60,000 across all your pension account, workplace pension, and your SIPP pension account. Okay, so those are the accounts that we can open. Start looking at which one, we apply to your personal, your individual situation to see which one you can do out of all of this. I put this here to encourage you. There are over 4,000 ISA millionaires in the UK. These people will never have to pay taxes anymore because they are millionaires in ISA. These people have been put, because ISA is now 25 years old. Some people have been putting in 20,000 on a yearly basis for the last 25 years. Okay, and now they have millions that they don't have to pay tax on. It's been tax-free since the last 25 years. We hope that will also continue. So there are billions in ISAs, and so there are people, a lot of people are doing this, and it's good for us to take advantage of it. So looking at investment platform in the UK, someone put in Money Boss Trading 212. So Trading 212 is an investment platform. Okay, I use Trading 212, Free Trade, and HL. Those are the three that I use. The ones with stars on them are the ones where you can open a LISA, a lifetime ISA, if you are under 40. These are the ones. The other ones don't offer a LISA. Okay, so any of this is where one can open some of these accounts. Some of them are cheaper than the other. Some are free, like Trading 212 seems to be the cheapest right now in the market, followed by Free Trade, but they offer different services. Some offer fractional shares, some don't offer fractional shares. Like HL does not offer fractional shares. in any of their platform. And then they also have ongoing charges that will apply. Okay, so those are the ones you can take a screenshot, or you can put in the chat. So I think along that line should have answered your question. Vanguard is also a platform. Do I have it here? No, Vanguard support. Okay, Vanguard is here. It's also a platform like any of these other ones. Okay, but Vanguard do more of ETFs. Okay, and they do more of ETFs rather than individual stocks. Okay, so doing nothing or procrastinating is riskier than making informed decision. Oh, I don't want to take risk. But when you do not do anything because you do not want to take risk, it's riskier than when you get the information and you let someone hold your hand as a mentor to help to guide you in making for you. You make that decision yourself, or somebody is guiding you to be able to make a decision based on available data that are available in the market. It's better that way than you not doing anything. So for you to become a successful investor, you need to be consistent, you need to diversify, you need to do research, you need to be patient, have a long-term perspective. I must say, you need to be able to manage risk, and don't follow the crowd. Don't follow during the pandemic when there was lockdown. People were following the crowd. People were putting money into speculative stocks. People were putting their money into crypto. And at the end of the day, some people they lost money because they were following the crowd. There's a need for you not to get greedy, for you to get that right education, for you to be able to. When I tell people I have not lost money in the market, is because on the average, I have not put my money into what, when I look at my overall portfolio, have I bought a company that went bust before? Yes. But when I look at my overall portfolio, I am in the positive. I have not lost any money when I look at my profit and loss account. Okay, and so it is possible. So that is investing in stock. Number one way for you to multiply your money. Number two way is real estate. I'm looking at my time. Okay, I'm going to run through this also. Number two way for you to multiply your money is real estate. And this is when you and this is real estate is investing in wealth building strategy. Real estate investment is wealth building strategy that involves purchasing, owning, managing, and profiting from real estate. It could be land, it could be buildings, with the intention of generating a return on your investment. And this is one of the greatest wealth building tool, as we know. If you've been around in this country in the last 10-20 years, you realize that the price of houses double almost every 10 years. When you look at a 50-year period, it almost doubles, almost every 10 years on the average when you look at a very long period. And so there is a need for us to also get on this. So statistics here is about the ethnic groups and how much property we are into. We have in the country. Black ethnic group has got just 20% of us are into our home property, while Arab is 17%, but the highest is the Indian household. 74% Indian household have their property. British is 68% household have their own property, and that's the average price and the rest of it. And 20% of Brits own their own home outright. It means they paid off their mortgage. Okay, 22% are on mortgage, 22% live in social housing. That's very high, and that 20% live in private rented apartments, while 5% of adults live with their parents, and that's statistics. So there's a need for the Black ethnic minority ethnic group to do a lot more. You can look at what the Indians group are doing. There's a need for us to do a lot more. There is, and these are the advantages why you should do that. Okay, it's the power of leverage. So you take 10% to bank, they borrow you 90%. They won't do that for you in any other investment. Okay, they will not do that for you in any other investment unless you have a business where they can give you a business loan and they put an interest on top of it, just like the property. But this is leverage. You're able to leverage the capital you have. You put in 25% for a buy to let, and they borrow you the remaining one. Okay, and it's capital appreciation. Like I've said, it tends to appreciate. And I can give an example of a house I bought about 12 years ago. It has more than double in price. If I can use that as an example, as a yardstick, it might not be like that in every region of the country, but over a long period, you tend to see that some people are waiting for the price to come down. well, what I can say is not likely the price will come down unless something drastic happen in the economy. There's a war or something like that. People are waiting right now for interest rate to go down by 0.5 or by 2.25, 0.25 to 25 basis point or 50 basis point or 100 basis point, which is 1% down, and people will see people coming out to come and buy in the market. So they will push the price up because I can tell us for free that they don't create more land again. Land creation has come to an has come to an end. You can feel a bit of the sea, but new lands are not being created since God created the world. Okay, so there's scarcity of land and there's scarcity of property. Okay, so it's rental income. It gives you cash flow. There's equity release, which you can release to buy new properties. A physical asset you can see and touch. There's housing shortage. It's diversification of your asset, and it's a store of value against inflation. Your equity remains locked in the walls of that building because your equity will always be in that building, no matter when the price goes up and down. A time will come when you'll be able to gain your equity. So speaking to that, as an example of a house we bought 2010, so it's going to 14 years from now. So the price has gone from there to about 155 when the last time I checked. This is an investment of 10,500 2010, and that has produced more than £500,000. And I sat down with my wife a few days ago and I said this could become £1 million within a few months. Because why? Because we have equity release here. Can release equity from this, and buy two more, and then this 10,000 has produced up to £1 million within a space of 14 years. And some people remortgage, some people pull out equity from their house almost every 3 years to go and buy a new one. So it means that from a single property, you could have up to 5 or 10 over a period of 10 to 15 years if you know how to do the remortgage, pull out equity, go into the next one, and the rest of it. So I do tell people, especially people who are just coming to the country, don't wait until when you can afford a mansion before you buy a house, for goodness sake. This is a 3-bed terrace house. Buy a terrace house. Don't wait till when you can save and have a status building. This is my status house. No, get on the ladder as soon as you can. The prices aren't getting cheaper. Okay, because the population is increasing, the rate at which is increasing is less than how much houses are being built, and so you don't see the price coming down. So get on it. I lived in this house for just 2 years. I moved to London in 2012 during the Olympics 2012. So I only lived in this house for less than 2 years when I moved to London. And and since that 2020, now people have been paying the mortgages and be paying whether I pull out equity to buy another one. I'm ready to pull out another equity, anytime soon. Okay, so get on it first, and then later you can buy that your big status house. Okay, and so different types of investment when it comes to real estate. Okay, you have all of this, and the popular one is what is called rent to rent. The only disadvantage with rent to rent is the fact that it won't give you all these benefits. You can't do equity release because you don't own the house. Okay, you get cash flow. That's all you get. It's not your physical asset. You benefit from asset shortage because you get customers coming in. It's not it's diversification. It's not a store of value because you don't own the house. It's not leverage for you, and it's not capital appreciation for you. It's for the person who owns the house. But what you get from rent to rent is cash flow, and it's very popular right now for either for Airbnb, for Bookings.com, and for the rest of them, or for people who are holiday letting and the rest of it, or for multi-occupancy, which a lot of us probably you've lived in house of multi-HMO or house of multi-occupancy before. Okay, so these are different areas in which you can invest into real estate. Time will not allow us to be able to go into a lot of these, maybe one by one, and that we make that available when you come for a more intensive kind of training. And before you apply for mortgages, which I think we all know, the things you need to look at, employment and the rest of it. And so I've just done a summary of that as we have 15 minutes left. I said the best time to plant a tree was 20 years ago, and the second best time is now. It means if you miss the opportunity of those scenarios I painted on the stock, if you miss the opportunity of buying a house when it was 70 or 100 or 250,000 around where you live, you have that opportunity right now. Things don't seem to get cheaper. Have you not noticed that once they've gone up, they don't come down again? okay, unless there's a serious recession. There was a recession in 2008, 2009, 2007, 2007, 2008, but the house prices have doubled since 2007, 2008. It has doubled again. And so the time to do it, to make an informed decision, is now. So in conclusion, these are the things I've looked at today, okay, and I hope you've been able to pick one or two things. I've been able to enlighten you in a very little way that web building is like agriculture. You can't plant seeds today and expect to eat bread. You can't put wheat in the ground today and expect to eat bread that same day. Okay, you give your seed time to grow, to flower, to have seed before you can have bread. That takes a period of few weeks or few months, depending on the kind of tree or seed that you are planted. And the why investment can go up and down by making informed decision, being patient and consistent with long-term perspective will make you a winner or a good investor. So you look at the fact that there's a need for you to educate yourself. Financial intelligence, very important part of the 7 pillars that we've discussed today. Increase your capacity to earn more. The more you learn, the more you earn. Plan to become debt-free. If you're already debt-free, avoid bad debt. Okay, control where your money goes. Have your budget, live within your means. Practice delayed gratification. There is a season for everything. Form the habit of paying yourself first into savings and into investment accounts. Invest consistently, strategically. Don't compare your progress with others. Avoid anxiety. This world is not a sprint, it's a relay race, and now your race and my race is totally different. Don't follow the crowd. Let God lead you and trust his leadership. Okay, and of course, enjoy yourself while you are doing all of the within the budget that you can afford. Okay, like I said, all it doesn't have to be abroad. You can have it here. And budget will help you to be able to do that. And so that is the training for tonight. And we do this once in a month. There'll be nothing in July. We do this. We did one 20th of June. Yeah, that's about a week or so ago. And there's another one coming in free. That will be August. That's a long time away. We are away on holiday in July, so there's nothing happening in July. And so we kind of try to educate. But beyond this is, if you want to understand this better, we also offer a master class, which is a Saturday, 5 hours on a Saturday, and then we just sit down and look at these things deeper, as you will appreciate that I can't make you an investor in 2 hours. And so we go further from these 2 hours. It's just a foundation, and then we now go into a 5 hours of training on a Saturday. Okay, and after that 5 hours of training, we now go into mentoring. So, and then you look at how do you build your portfolio, how do you put things, diversify that portfolio, how do you look at your risk management through diversification. You look at that, then you look at there's going to be mentoring after that, so that you can open your portfolio. I said this is worth more than 500, but you're going to get it for free. We have a small group of people that we are in a group, in a Discord group, where we talk about investment. It's not a noisy place. Maybe once a week, maybe once in 2 weeks, we talk about this. We just post 1 or 2 things there. This is what about a subscription, about £10 on a monthly basis, but you're going to get that for free. And so if you are interested in this, I'd like to go further in your understanding of how to invest, on how to build a portfolio, just like I said I'm doing right now. You might want to join me in that class, and that class is happening on the 6th of July. Okay, another one is 14th of September. But I would say do not procrastinate. If you can make it the 6th of July, please do come around. It's 10 a.m. to 3 p.m. on a Saturday, and the price is just £100. Like I tell people, the level of value we offer, you don't get it for less than £500 or 1,000 for the level of value we offer. But I am passionate about this, and I want as many people as possible to be able to understand this. When I understood it, I was extremely glad, and I'm happy to offer this knowledge and this support for as many people that will be interested at that rate. And in fact, I think the rate, because I went for an exhibition a few weeks ago, and the rate was actually reduced to £80. there is, and there's also a bulk registration. If you are coming together as a church, at least 5 people from your church, you're going to get it for 80 pounds each. If you are coming as a group, 5 people, we get at 80 pounds per person. And to do that, you go to IBWFG, or you come to me. If you are coming as a group or individual, go to ibwfg.com. You can register from there, use PayPal to pay, or do a bank transfer, and then you're on your way to investing. So questions, please. I must not overshoot my time. Okay. Questions, please. Feedback. Something is not clear to you, I'm very happy to answer your question, and that is my phone number down there. You can follow us on social medias at IBWFG, and that means I build wealth for generations, and that's the meaning of that handle. We're on YouTube, TikTok, Facebook, X. You can follow us for more details. Okay, anyone there? Question? Let me clarify. What is it that it is not clear based on the things we've looked at today, or things maybe some things I've not mentioned, I've missed out, that you might want to ask question about? So there's something in the chat. Fantastic. Well done. Thank you very much. This has been an eye-opener and a blessing. Thank you very much, sir, ma'am. I appreciate your feedback. Okay, any other question or feedback? Any question or feedback there that you want to ask? Anything not clear to you that you want me to further explain? Okay, so don't forget how we started. A part of what you earn is a seed. Okay, it is not good to eat it all. And when there's a need for us to keep aside something. Don't forget, Isaac, the farming was severe in his days. He kept aside a bit, and when God instructed him, he planted it, and he got 100-fold return. And so that is what we should be looking at. Okay, let me see if I have my confession of faith here. Okay, in the absence of no question, I don't know where I should hand it off over to coordinator, or okay, let me hand it over, because I think we have about 8 minutes left.
Thank you very much, Tayo.
You're welcome.
And good evening, everyone that has joined. Tayo has given us a little bit of what can be done. And the beauty about this thing is that it can be done passively. But you will need somebody to hold your hand. Tayo is not paying me a penny, but I can tell you that this is probably the cheapest master class I've ever come across. The £100, if you did that simulation that he did, even if you're using £100, you notice that you cannot lose out over the course of the years. And the truth about it is that if you're asked to save that money yourself, you cannot save that money, because it is insignificant as it were, but on the long run, the principle of compound interest makes all the difference. In all honesty, what Tayo is telling you, it might become something that you may not get your head around until you start it. I actually met him by chance, and when I listened to him, I felt we will all benefit from this. So that's why I approached Pastor to get this across to everyone. And it has been open to everyone, because it doesn't have to be the men or the women. Some people are much more tuned to taking this kind of decisions. But to be honest with you, I can tell you I'm a beneficiary of this. I have joined the master class. If I had the 80 pounds is offering is cheaper than what I paid. So you may have to give me 20 pounds back. So, so I will encourage everyone to take the chance. It's a question of knowing how to fish rather than somebody giving you fish, and your level of investment can be as much as you can. Nobody's going to force you, but you just knowing that okay, I have £5 to put in here. In fact, I was teasing my wife the other day that I think one company declared dividend and they paid me a little money. And I just put money in that company a few days before. So the bottom line is the choice is yours. The ball is in your court. How you want to kick it is up to you. You have somebody to hold your hand and somebody that you can always reach. I can talk to Tayo 10 p.m., 9 p.m. That is the truth. The Bible said, no liar will make heaven. And that's the truth. You can get hold of Tayo, and sometimes I actually wonder how he shares his time. So, Tayo, thank you very much. And thank you for making this possible. So, for those that want to take advantage of the masterclass, the information he has shared is there. And just in case you lose it, we can always get a hold of him to send that information to the church for us to take advantage of.
Thank you very much, sir. Okay, I'll stop sharing my screen now. Okay, thank you very much. Okay, so I think we'll call it a day, isn't it? So do have a wonderful evening. Have a good, thank you very much, Ma. Thank you, sir. Have a wonderful week ahead, and God bless. You're welcome. Thank you.
Thank you so much. Thank you very much. Thank you. God bless you.
Thank you,
Thank
sir.
you so much. The Lord rewards you. Thank you.
Amen. Amen. Thank you.
Bless you. Thank you, Tayo.
Thank you, everyone,
Thank you
for
very
joining.
much, sir, for the opportunity. I appreciate that. Thanks.
Bye-bye.
Okay. Bye-bye.